Hi, morning all. What we're going through is the presentation which we made to the analysts, investors, bankers, etc. on Wednesday morning. There's an audio version of it on our website, so you'll be able to see the extent to which Dan and I go off track compared to that. I'll give an overview as to the business. I'll hand over to Dan on the numbers, and then I'll come back to summarize. So looking at the performance year to date and the outlook for the rest of the year, um, we're pleased to report that we're in line with what the board and the market have been expecting. We're comfortable with that. There's been a lot of changes going on in the business, and also there have been one or two tricky headwinds operating for us. So we're very pleased to be very comfortable with the numbers which are in the analysts' forecasts. A few positives so far is that our records management business is the key driver of the group's profits and cash generation. We were very pleased that we had a much needed price increase, which in January of averaging about 7%, which caught us up with the inflation of the last few years. That stuck. Our costs are very strongly under control. We've switched our strategy in this business from chasing volume to focusing on operating margin. And I'm very pleased to note that this business continues to be a very strong business and operating margins are increasing. Also pleased to report that data shred, I'll go into some of the stuff in more detail, particularly in the summary, has been operating very strongly. It's a business which some of our investors have said, is that really worth the bother? And I'm very comfortable with the operations in that business, which has been more impressive than I might have feared when I came back to run the business in September, having run it for 10 years prior to that. Also very pleased to announce that I think it was Tuesday, we had a major contract win in our digital business, which our digital business is broadly a scanning activity. And this is a mailroom for the Department of Work and Pensions. That's probably about £12 million a year for 6 years. There have been a few things which have gone against us. We're the UK's preeminent mover of professionals. So we also move a lot of laboratories. We do some heritage moving, but predominantly we're mainly moving offices and universities and things like that. We found that particularly in London, the market has been very, very slower than I've ever seen it. Which we think is a combination of people just not making decisions ahead of the election, but also an element that possibly over time we're slightly shifting our model away from the very big office moves, particularly in the city, to we're seeing fewer of those, which we need to sort out our resources to address that, and also to focus on other parts of the market. A key feature about our data shred business is that a third of our revenues derive from selling the paper which we collect from the bins in people's offices. This is very high quality paper. It's very much in demand by UK mills, but the price since COVID has moved all over the place. And in particular, in the first half of the price moved around during COVID. There was a lack of paper. The price spiked very dramatically and then fell very dramatically. So as an example, in H1 2023, the average price of a ton of paper was £220. In H1 2024, the period just finished, the price of paper was £155 a ton. So if you do the maths, we're getting on 25,000 tons, because we do 50,000 tons a year. We received £55 less a ton, which basically meant that the revenue fell by 1.7 million on paper sales, and that 1.7 million dropped straight to the bottom line. So that's something which is quite difficult to cope with, both inside the business and as a group. But that is an extremely well-run business, which meant that the impact was such that the year-on-year performance was we didn't lose that we were much less than 1.7 million behind, which you would have expected on a constant performance. And also, we've recently, just as we won the Department of Work and Pensions for their mailroom. We lost an agency contract with another large government agency, which is worth about half as much as the one we won. We see the immediate opportunities as being pretty clear. We will continue to drive operating margins in records management. We have many sites across the group. What you want to have is big sheds in cheap locations, enabling costs of storing a box to continue to fall, or at least to fall. So what we've been engaging with is looking at some of our more expensive sites. We've taken on a new 100,000 square foot site in Chesterfield, and that will dramatically reduce the costs of storing 1.4 million boxes, which will drive up operating margins. Very pleased to say that, having been on the wrong side of the paper price for the last 12 months, we're seeing the paper price strengthening considerably, and that will give us instead of being a headwind, that will give us a tailwind in H2 2024 and hopefully into next year. We're also pleased that one of our divisions, which has been problematic, what's called technology, which is actually IT recycling, that we've seen strong signs of improvement in that business in the last few months after undertaking a lot of changes during the period. Could I have the next slide, please? I think there we go. So what have we achieved? As some of you may be aware, I came into this business in 2009 when it had a market cap of £1 million, and I left after just under 10 years, having felt that I'd done enough. At which point the shares, I think, were about £5. And the market cap was about 500 million. So I came back last September. A real part of my focus was, I felt that in the time that I was away, there was a lot of focus on what I'd call big company management style, which involved considerably bigger presence at head office. When I left, there were 7 people at head office. There was over 50 when I came back. And the business model, which has found works best well here, is enabling those who run the businesses to have responsibility for them, not spend their time having to produce endless papers for head office to help them make decisions for them. So that was certainly the first 3 or 4 months, was reintroducing a culture of people in the operations having power and responsibility to run their own businesses, and having a much more slimmed down head office. We've also, over the last 9 months, as I've noted, reduced the head office cost, but also Dan can talk about what we've achieved on the treasury side, where we've managed to set, despite the increase in interest rates, we've managed to reduce our banking costs quite significantly. As noticed earlier, we're very pleased with records management, where our focus on operating margins, rather than on trying to show that what is a mature market has got significant growth in it, we have been tweaking the dials, particularly through the property angle, but that is driving group profitability. That change of focus was very much welcomed by the management of that division, who were struggling to drive up volumes, but found it very easy to drive up operating margins once they weren't focused exclusively on volumes. We've also, our technology business, that is IT recycling, in which several acquisitions were made in the time that I wasn't present in the business, we found to have been doing too many things, some of which were extremely low quality, low grade. When you're recycling IT, you want to recycle IT for blue chip companies who value our services, and government departments who value our services in terms of security, in terms of how we dispose of the IT which we're recycling. And at the same time, so that is the market. We do not want to be rag and bone men, and we disappeared into that market in some places. So we have 2 strands in that business now. One is end of life IT recycling for quality companies and government agencies, but also there is a burgeoning opportunity in this space in what's called life cycle services, that is when one works very closely with the sellers of new equipment, and their customers, such as the Department of Work and Pensions again, they want to be able to track their equipment. They want to know that throughout its life, it is being monitored, so that when people are working from home, if their computer's not working, they know how to get it repaired or send it back so it can be reconfigured. If somebody leaves the business, they want to track it. And then at the end of the product's life, they want it recycled properly. So what you've got in that is you've got a very different approach from the customers, who want appreciable service level agreements. They want to know exactly where everything is at any time. So that's a business stream which we are confident is going to be growing fairly significantly. And we've been working on reconfiguring our branches and reconfiguring our IT systems so that we can respond to focus just on these two markets and integrate the operations between our various sites, which have been operating very disparately and very inefficiently. Datashred has got a lot of advantages in its market. We are one of the two main players in there. You should be aware that of our 5 operations, 3 of them are comfortably the market leader, and 2 of them were one of the 2 main players, and that applies to Datashred. In that space, we have particular advantages insofar as we have a captive audience for about 50,000 tons. 10,000 tons comes from disruptions within the records management business. We are also very well invested. We have advantages insofar as we can share sites, particularly with records management, therefore ensuring that data shred collection sites don't have any rental costs. We have a national network. We've also seen that with the fall in the paper price, it's been very painful for some of our smaller competitors. Harrow Green, the preeminent office removal business in the UK. We've spent time investing in our specialist services. We've moved to probably the biggest pharmaceutical company in Europe. Recently, we moved their laboratories. We've built a biobank in Cambridge for storing plasma. We opened a branch in Oxford, which we expected to lose money in its first year, and it's actually turned a profit. So whilst there are some shifts in terms of the level of activity in office relocation, particularly in the City of London, we're going out into other areas where we see higher margins, and we expect that to be able to replace some of the revenues which we expect to be lower in places like the City. And I'll ask Dan will comment on the leverage position and what's been happening to our gearing in his section, but that's been a success. So in terms of ongoing action, we announced on Wednesday a significant change to digital, which is our IT scanning business. We acquired a business 2 or 3 years ago, which was a good acquisition because it was the market leader in UK scanning when we were probably the number 2. And so the combined businesses are by far the preeminent business in the UK in scanning. Unfortunately, those branches that business over the last 2 or 3 years, there was very little integration of the activities there. It ended up post-acquisition that we had 10 operating sites around the UK. What we announced on Wednesday means that we will come down to 2 primary sites, both in Wolverhampton. One site is a mailroom site. That's so that when you send, for example, a letter to HMRC, it actually comes to our offices in Wolverhampton. We scan it and we have it delivered to the recipient's desk electronically later that morning. That is that is what one of our sites does, which is called electronic mailrooms. And our other site is really designed for bulk scanning, which may be doing large hospital contracts, but day-to-day scanning for a very wide range of customers. By doing this, we've reduced significantly excess capacity across the business. It means where you have one large site, and when I first visited Wolverhampton, we had 250 operators' desks, of which only 80 were in operation, if that. And that's enabled where you have a big site, you get benefits of scale, and therefore you drive margins. I think the other thing which is really interesting is certainly over the last few years, what we've found is a lot of our customers, particularly our records management customers, where we store their physical documents, are interested in how we can help them work out what they should store and what they should digitize. And having 2 divisions, one pitching records management, the other pitching scanning, has been unhelpful, as our customers really want us to help them address them with both of these. Partly as a result of that, we've seen that our businesses, those two businesses, have frequently provide the same services in different ways. For example, if I look at the work which we do for HMLR, the land registry, this is actually a records management contract, but the land registry, very sensibly, when somebody asks for material, have set up such that we then scan that material and then subsequently destroy the boxes apart from the most important content therein. So that was that. So we've been doing a lot of scanning anyway in our records management business, just responding to the needs of our customers. Increasingly, I found on visiting our sites, which that we have got small, inefficient records management operations where we undertake scanning, and it is much better that the scanning and storage are provided under the same roof, so that we don't end up with somebody in a warehouse trying to scan 10 boxes. The upshot of this in financial terms will be that there will be appreciable savings, including from the merger of the two senior leadership teams between the businesses, which we estimate at £3 million a year. The cost of that integration, we believe, will be around about 3 million, and most of that should be complete and the costs taken in the first half of this year. Brilliant. So that's the overview. As I say, I'll come back to talk about the summary, and let me hand over to Dan to talk about the finances.
Thank you, Charles, and good morning, everyone. Right, I will take you through a summary to start off with, and then we'll unpack the detail a little bit. Conscious of time, it's about 9:18, so I'll probably try to do it in 5 or 6 minutes to allow time for Q&A. So just on the summary, broadly flat on last year, so 139 million revenue. That's basically the same as last year's first half. There's some ups and downs within that, so strong performance within records management. And that's, as I think Charles mentioned, driven by essentially inflation-linked price rises on our storage revenue. The number of boxes we've got is flat in the last 6 months, so 22.5 million boxes now, and 22.5 million boxes at the year end, so stable number of boxes. As Charles mentioned, technology starting to benefit from the global IT recovery post-COVID, so start to see some green shoots there. But we've lost one-off contracts in digital. So last year we had some large scanning contracts, particularly in the NHS. We've also got the impact of the paper price, as Charles mentioned, and that's when you compare this half to last half, so you have got a headwind there, and the slower removal market impacting the Harrow Green business. So that translates to an operating profit of almost 24 million, a margin of operating margin of just under 17. That's up from last year, but both in absolute terms and margin terms, and that's effectively the records management price rises coming through, together with cost management in the businesses and reduction of people in the head office. Profit before tax 16.3, that's up 8% from last year. It's a little bit less than the operating margin increase, and that's because of the impact on finance costs, which we'll unpack a little bit later in the presentation. And then earnings per share of 9 pence, up from 8.4 last year. Just come to the next slide, Hannah, if that's okay, please. So adjusting items. So these are items that we have incurred, but we take out of our presentation, and I'll go through the detail later on so that you can see what they are. Most of them are non-cash, and they relate to amortization. So that's on the acquisitions that the business has made over the past few years. So we adjust those for the purposes of our adjusted profits. There's just over 1.5 million of the cash adjusting items, and I'll cover exactly what they are. Significantly down on last year's adjustments, and that's because last year had a very large impairment on the goodwill on the data shred acquisition of 32.5 million. So we haven't got any impairments this half, thankfully. So the numbers are starting to normalise a little bit more. Interim dividend of 2p. That's effectively increased with the profit increase. Cover of 3.3 times. That's the same, and we intend to keep it that way. So dividend will track the profits. Net debt, as Charles mentioned, down 4%, 93.5 million. We've got two portions of debt. We have a revolving credit facility and RCF with a syndicate of banks, predominantly UK banks. We've also got some fixed US private placement, 25 million of that. So those are our two sources of lending. We paid down 17 million of the credit facility in the first half of the year, so it now stands at 80 million. It was 97 million at the start of the year. And as a result, leverage is down from 1.9 at the start of the year to 1.7 now. We state our leverage we want it to be in the range of 1.5 to 2. So we're tracking down that range, but still firmly within it. So just looking at the detail a little bit more. So this is bridging last year's first half revenue, 139.6, to this year's first half revenue, 139.4. So just moving left to right on that chart, you've got price rises coming through. Most of that is the records management price rises on the box storage. We also have increased the prices on the other things we do with the boxes. So when people pull the boxes out to have a look what's in them, that incurs a charge as well, and we've right-sized the charges on that as well. Then we've got headwinds from digital, and that's the loss of the contracts, one-off contracts I noted in particular in the NHS bulk scanning. Green shoots on technology, so that's the IT market starting to come back. We've also got a stronger pipeline for the second half of the year as we can see companies refreshing their hardware. So that's nice to see. Data shred. So as Charles mentioned, that decline is wholly due to the paper price. I think Charles covered the difference in the paper price half on half. Actually, that's 1.7 million of profit. You can see only 1.1 on the revenue, and that's because that business has done a really good job of increasing the underlying work. They're doing more visits. We're shredding more paper, so actually they've mitigated more than mitigated the impact on the paper price drop. And then Harrow Green, that's the slower removal market that we've seen this year. Then just on the next slide, looking at the impact on profits. Thanks, Hannah, for moving on. So similar story. So you've got pricing coming through, then you've got an inflation headwind, and that is essentially people and property. They are our two largest costs. Almost all of our properties are leased. We've got one or two that we own, but we've seen headwinds there. And a large number of our people are effectively blue-collar workers, so paid relatively close to the minimum wage. So we've had increases there, so that's seen as a headwind. Then had the paper price that we've mentioned. Then a green bar is the cost savings. That's in head office, so significantly reduced headcount there, but also out in the businesses. Headwind on Harrow Green. And then a net decrease in increase rather in finance charges. So let's just have a look at that on the next slide to explain what's going on there. So if you look at this half of the year versus last half of the year, the interest rate, the Bank of England rate, is up a percentage point. Now, I know we had started the decrease yesterday, but half on half, we're up a percentage point. So that just hits straight our bottom line. Previous management did have some hedging in place, but a little bit shutting the stable door off the horse has bolted. It kind of didn't stop the interest rate coming through. Just looking ahead, we haven't got any hedging in place on our facility, on our RCF facility, and that's because we think it tracks the Bank of England rates effectively. So that's because we think that will turn into a tailwind. Fingers crossed. You then got savings in the interest because of we've paid down the credit facility, as I mentioned earlier. Now that's partly through trading cash flows, but it's also through a reduction of cash on hand on the balance sheet. Previous management used to like to keep quite a large buffer of cash on the balance sheet. We don't see any benefit for that because we've got a really stable business. We know what the cash flows will be. We don't earn any interest on that cash that we're holding. So what we've done is reduce the cash. It was 23 million at the year end. It was 30 million the year before that. It's down to 10 million now. Actually, we looked yesterday, it's down to 0 now, which is exactly where we want it to be because there's no benefit from us having cash on hand. So I'm trying to get that on a daily basis as close to 0 as I possibly can. It was 10 million at the half year. So we've used a combination of trading and the reduction of cash on hand to pay that loan down. We've also cancelled some of the credit facility. At the end of the year, it was 200 million. We weren't using that. We weren't using anywhere near that, but we were paying for the privilege of having that extra facility. So we've trimmed that down, 125 million now. We were paying for that facility, so we get a help on having less fees there. So net 0.2 increase, but that's because we've been working hard to try and good housekeeping really, to try and keep the costs as tight as we can do. Right, the next two slides look at our divisions. So we've got 5 businesses, as Charles mentioned. We manage those within 2 divisions. We are looking at what we call these because it's not entirely logical. The first division is a combination of the records management and the digital scanning business. So we call that digital information management. This slide just shows how that tracks half on half. Records management dominates that division. So you have got a net increase in revenue and an increase in profits, and that's because you've got records management doing so well, as mentioned. Against that, you've got the digital loss in revenue and profit, but RM dominates, records management dominates. So net an increase there. Just on the pie charts on the right-hand side, thought that might be useful just to dwell on a little bit for you, as some of you might not know the company as well as, say, the analysts. A large proportion of our revenue is recurring. So the boxes in the records management, they are there pretty much come rain or shine. As I said earlier, that's a stable number, so that will be there, and that's really lovely as an FD to wake up knowing that those boxes are earning as income. We also within digital have very large mailroom contracts and exam contracts, which we know will come each year. Mailroom is dependent on volumes, pretty much you know where you're going to be there. So a high proportion of sticky revenues in both those businesses. Just looking at the next division, so that's a combination of our technology, so the IT recycling, the shredding business, and the Harrow Green, the removal business. So that's called Secure Lifecycle Services. A less good picture there, half on half. And that's essentially the paper price has really hurt us on the data shred revenue and profit. Harrow Green has been slower, but we are seeing some of those headwinds turn into tailwinds. So as mentioned, IT is starting to come back. Shreds, the paper price is now back within the long-term average. So when Charles was here the first time round in his later years, it was always tracking around 160 to 190 a ton. It's now, I think it's about 190 a ton now, so it's now back in that range, which is good, and that will be a tailwind for the second half of the year. Harrow Green, we've seen a busier July. Almost as soon as the election happened, I think things start picking up, so that should turn into a better second half of the year. Just looking at cash flow onto the next page. So the business is really cash generative. Something we say is we want to keep cash conversion of at least 84%. So that means the difference between how much the P&L throws off in profit and how much cash comes through in free cash. So after we've spent capital expenditure and so on, that's 84%. So very strong, and that will continue to be that way. We've got net debt coming down. We've got leverage coming down. We're well within the covenant requirements of the bank, so no worries there. We have purchased some shares, some of our own shares, and that's satisfy our option schemes. So we've now purchased 1 million shares, an average price of £2.60, some before the half year, some after the second half. Don't anticipate doing any more now because we think we've got enough to satisfy the shares. Then on my last slide, just coming back to those adjusting items I said earlier. So you can see that the breakdown there, and you can see how it's reduced half on half, and that's because we haven't got the impairment coming through this time. But also it's a large chunk of that is amortization, so that's not a cash item. And most companies do adjust for that, and I don't see any reason why we would change it going forwards. What we're actually doing on top of that that's costing us cash is, as Charles mentioned, so we've got the right sizing of the digital group functions and digital going on. That will come through, that scanning costs will come through a lot in the second half. So just a reminder, we think that will be up to 3 million in total. Probably most of that will come through in the second half. We've then got some property costs coming back. On our property portfolio, what we're doing is looking in records management, Charles mentioned, consolidating the large sheds, consolidating into large sheds. And what we're doing there is we have double rent costs, and we also have the logistics cost of moving the boxes around. So that was 0.4 million for the first half of the year. There'll be a little bit more of that in the second half because we should be out of the two sites, Redhill and Paddock Wood, in the second half of the year. And then lastly, on the adjusting items, we've got IT costs. Previous management started working on a group-wide project to put a new finance system in. We've curtailed that early. We've done just Harrow Green. Harrow Green went live in June, but we're not going to move we're not going to move records management onto that because we don't think it's necessary. It won't help run the business better. So we've stopped that now, and so that will go away going forwards. So that's it from me. I'll hand back to Charles for a look at the outlook.
Great, thanks, Dan. I'll speed through this quite quickly. Key thing about our business is we've had very, very strong recurring revenues, which gives us a lot of stability. Records management is obviously the big daddy in this, with very, very secure revenues, very easy to know, to predict what sort of revenues and profits we're going to make. Fun enough, in our digital business, you'll find that between our electronic mail rooms, which are heavily contracted, our online storage, our exam contracts, that actually in that business, the bulk of the revenues are recurring and predictable. And then the remainder of it is filled up with bulk scanning, most of which we have some visibility on. Shredding is a very steady business. Most of the contracts run for 3 years. They typically are renewed for another twice. So a typical length of stay of a customer is at least 9 years, which means that we can project that very, very precisely, with the exception of the paper price, which we're working on stabilizing that, but through improving our relationships with the UK paper mills. Our life cycle business, increasingly with our IT recycling, our life cycle element of that is eminently predictable. We have an idea of who our customers are, how much equipment they're going to be asking us to process. And so we have, across the group, we have a lot of visibility of the revenues which are going to recur. Skipping through the outlook, records management will drive up margins. By integrating records management and digital, we will improve the combined operating margins of those businesses. Technology, we've been working very hard on that in terms of repositioning it, taking us away from the low quality equipment, improving our operations. And actually, we've got a bit of a following wind because global IT hardware sales, which fell dramatically after a big spike in 2020 when everybody refreshed their equipment. What we're finally seeing globally is that IT hardware sales are recovering, and when people buy new bits of kit, they throw out the old ones. Data shred, we're very pleased with. We've got a following wind. We're operating very efficiently, and we've got a following wind in terms of the paper price now picking up to more typical levels. And with Harrow Green, as I mentioned, we've seen a very, very slow first 6 months. We're beginning to see it picking up, but we've had to rejig our London capability just because we've changed working practices, fewer massive office moves from the big banks, and also the nature of working with hot desking, etc., means that when people move their floors and things like that, it's probably less complex than it used to be. Great. Last slide, please, Hannah. Thanks very much. So the key messages are that we set out our stall 6 or 7 months ago, just after Dan joined, to say that our role is to get the group we are targeting, and what we really want to achieve is 20% adjusted operating margins in the medium term. We are still reasonably confident in that. I think the integration of our scanning operations into our records management operations is going to drive operating margins there. Our IT recycling business is doing much better. Data shred, as I've noted, is doing very well, both through improved operations, but also will be helped by the improved paper price. And then Harrow Green is never going to be a 20% margin business. We do well to get 10% out of that, but we feel comfortable that we can get to that 10%, which, if everything comes right, we should achieve the 20% operating margins across the group, which we were achieving 7 or 8 years ago. We have same old story. We're market leaders in what we do. We've got strong recurring revenues. Cash generation is very strong. even in a year such as this year, where we have quite a lot of one-off expenditures relating to things like building a new site on our freehold in Sittingbourne, that despite and more than the costs of integrating digital with records management, that we're still seeing the net debt and leverage fall this year. So overall, where we are is our records management. We have great visibility. It's going well. Digital, by being integrated into records management, there is scope for further improvement in that business. Our IT recycling business is beginning finally to come back to the right place. Data shred operation strong, the paper price is good. So in the current year, with the exception of Harrow Green, we expect all of the other four operations for their operating margins to improve, which has been our long target. Overall, having come back 9 or 10 months ago, I'm now really confident we've got the right people in the right mindset, in the right place, in the right structure. So Dan and I look forward to the future with great enthusiasm. Thanks very much. Hannah, questions?
Is the head office streamlining complete, and how big is the team now?
Well, why don't I do that to save Charles, give him a mini break. So I think when Charles arrived, it was 50 something. It's now about, I should write it down, actually check, it's now 11. So the difference is there was central marketing teams, central sales teams, central business development. There was a risk function. So we don't feel we need all that, and there was some HR people in the centre as well. So we don't feel we need all that. So we're down to 10 or 11 now. And I think one of the questions further down, I was just looking at the Q&A, is it complete? Yes, we're at that right level now, and we don't think we need to go any more than that.
Fantastic. Thank you. Right. M&A. The past CEO had a long list of M&A opportunities. Is this something that you have, or is the margin progression the priority?
At the moment, margin progression is the priority. There are two of our businesses which lend themselves very much to consolidating markets. One is our records management. When you buy a business, what you find is that the boxes transfer over to you with very few customers leave on the point of an acquisition. So that there are fewer opportunities there, partly because we picked up most of those opportunities in the previous decade. Where we also see in data shred, that's been a very fragmented market. Again, it's a situation where the contracts are fairly secure, so making acquisitions in that space is a good idea as and when they appear, and as and when they appear at the right price. Of our other businesses, they lend themselves less well to acquisitions, partly because what you're acquiring is relationships, and that is a tougher area to ensure that you achieve the projections from when you've acquired the business. So having said that, our main focus is on driving up operating margins and reducing debt over the next 12 months. At that point, we will probably be below our desired gearing level. I quite like this business takes a lot of gearing because of the predictability, particularly the records management business. We will probably at some point next year be below 1.5 times, and at that point we have options to look at more aggressive acquisition activities or returning funds to shareholders.
Okay, well, leading on then, there's a question here about, particularly consolidation and shredding. Are these going to be small bolt-on, or are there larger deals out there potentially?
There aren't in our two key areas for acquisitions, records management and in the shredding business. No, it's about small add-ons. We have fantastically efficient operations in both of those. It's a very straightforward picking up the contracts and taking out cost.
Okay. And is it a case that, with another question here, you want the leverage to get to that 1.5 times before you embark on that activity?
No, we can do that as we go along. As we've said, probably this year we have about £15 million worth of cash costs, which we won't have next year, and the debt is coming down. The largest one of those is we have a freehold site in Sittingbourne, which we were required by a very important customer to have a freehold for their services. That we also, and on that site we had a lot of surplus space. Property in the southeast is very expensive, particularly sheds, and so it's made sense for us to spend 4 to 5 million to building a new records management facility there. Generally, we prefer to have records management facilities outside of the southeast, but there are certain customers who require us to be able to service them from the southeast. So that's been quite a big cost. We've kitting out our new facility in the Midlands in Chesterfield is £1 million. Moving the boxes there is another £1 million. We have £3 million of one-offs related to the integration of digital into records management. And there's, what have I missed out, Dan? We will have a dilapidations cost of moving out of a couple of sites, which is cash, and I've missed something.
And we bought the treasury shares for the shares.
Sorry, and also we spent £2.6 million buying £1 million of shares for our EBT. So what I'm very pleased with, and shows the strength of the business, that even with those significant outflows, which will not recur, actually the debt is coming down pretty fast from the top end of our range to the middle to lower end.
Okay, I think that is it on acquisitions. Let's move on to margins. As you reinforce your 20% target, does the drag from Harrow Green make you question its future role in the business?
I think the thing about Harrow Green is that it's very capital light. You need to buy vehicles, but otherwise there is no capital investment in that business. Therefore, the return on invested capital is very strong. Yes, we've spent £500,000 building a biobank in Cambridge, but generally this is a very capital light model. So we do well to achieve the margins that we achieve. We're not achieving them at the moment because the first half has been very slow. It also works incredibly well with the rest of the group. For example, on the very big move, it was the BBC who we moved to our site in Sittingbourne. A huge amount of that was there was concern with the client about, they appreciated our capability of storing and it's all in very specialist vaults, but actually the move itself is very sensitive. So we found from that actually having Harrow Green as part of that process, as it is with quite a lot of heritage of our heritage customers, that's incredibly helpful. You'll also find that Harrow Green will do, for example, at the moment we're clearing a lot of BT sites. That has led to a lot of IT equipment going through our recycling, going through our IT recycling business. So whilst it's a low margin business, it's a capital light business. What you'll have seen is if we were to lose 2 million of revenue in our box business, that would go straight to the bottom line. But actually, with Harrow Green, a lot of the costs are variable. So we're very comfortable with that business. We feel that the quality of earnings is possibly less than in the rest of the group, but it's a valuable service to be able to provide, and the return on invested capital is exceptionally high.
Okay, and perhaps then on the flip side, you speak with a lot of confidence that margins in some of these businesses should be higher with the relative importance you have to your client's business. You touched on it there with the BBC. Does that give you confidence that 20% is only the medium-term target and you could go higher in the longer term?
I think if I look at 2016, 2017, 2018, we were doing 20% margins. I think that's probably that should be the run rate of this type of business. We have recurring revenues. We're very important to what we do. To be honest, I suspect that over the next year or two, some of these businesses will be better run than when I was running them 7 or 8 years ago. Certainly, records management has always been a very tightly run business. But I think in businesses like Data Shred, we're running the business better than we were in 2018. So there is some scope, but I think in our 20% will do.
Enough for today. I like that. Could you please offer some more detail on the expected improvements in operating margin following the integration of records management and digital?
I do that one, Charles. So the 3 million savings will drop straight through to profit. So we don't disclose the individual margins of each of the 5 businesses. We aggregate them in the 2 divisions. But we have said we want all the businesses, with the exception of Harrow Green, to get to at least 15%. Once we've done that restructuring within digital, that business will then be at 15%. Hopefully that helps.
I think also the strategic benefits, which we haven't put into that, in terms of this increasing need for our customers to, for us to help them on what they should digitize and what they should store. That people say, well, aren't you cannibalizing your business? Well, actually, it costs £150 to scan a box, and it costs £4 a year to store a box. So really, where we're trying to help our customers is saying these boxes are always whizzing around. You know, you should scan those. When you consider that when you're retrieving boxes, consider whether you want to scan them for the longer term. I think, funnily enough, what the Chancellor was saying, and we see extraordinary wastage in the public sector from people not outsourcing these sort of services. I was also pleased to see Rachel Reeves saying they don't particularly want to spend a fortune on consultants. And I think where we are at the nuts and bolts end of these businesses, we can go along to government, and we've tried it before, but it's quite difficult to get to them and say, this is, I have an example of a hospital where for a spend where we advised them on, well, but somebody else advised them, but we did the donkey work, where they had their, and a lot of NHS trusts still have this as well, they have their patients' records on site. And in this particular instance, the cost to the client was £5 million. They saved £3 million. That department went from having 101 people in it to having 4 people. We moved a lot of the records off-site, and we scanned quite a lot. And when you scan the most recent medical records, what you have is you have far better sort of patient outcomes. It's easy for the consultants, it's easy for the receptionists. All the processes work far better. And we, in that particular instance, I think we advise the customer, do not scan more than, do not scan your entire estate. What the consultant wants to do is say, what's happened to this patient in the last 3 months? In the event that they go, actually, let's look back at their history. At that point, you go back and look at the last 30 years medical records, which obviously nobody wants to throw those out just in case this happens. And so the cost savings there was £3 million a year, plus the hospital got 15,000 square foot of hospital back. There are many examples of this. There are certain government agencies who still do their own records management. And I'll give you an example of how this works. 30 years ago, the cost of storing a box was actually slightly higher than it is today. And so what's happened over the last 30 years is operators, not just us, have driven down the costs of storage for our customers, and they have benefited hugely from that by the fact that inflation adjusted, their records management costs are at least half in real terms what they would have been 30 years ago. Probably, I mean, I've done the math, but then it looks absurd that it's a third of what they were then. So this is outsourcing, a critical thing which you've got to do. Where you've got certain government agencies, their costs are still the same as they were in the 90s, because they will have seen increased property costs, increased labour costs. So the savings we can generate for those people now are really significant. And I would be, both as a taxpayer and as a citizen, I mean, I really don't want them spending £10,000 a day with a consultant. I want them to come to us and say, okay, here we are, what do we do? And we can say, this is what you do in this situation. Should you scan and destroy? Should you scan the whole lot? Should you, and for a lot of people, the answer is actually to scan and restore. But restore with us, where our costs of storage, because we're continually fighting to take it down, all our efficiencies, we should be in, if the current government follows through on what it wants to do in terms of waste, of government waste, I wish they, I wish they come talk to us, because we could point out hundreds of millions of pounds just through using us. And I think also one of the strengths of our business is that in the areas in which we're active, what we're trying to do is we're trying to make our customers sleep well at night. They know that their documents are being looked after. They know that they're getting their electronic mail through in the right order. They know their IT is nothing's going to landfill. They know that they get all the certificates showing that it's been wiped. They know that all their shredding has been done. We're helping people to sleep at night is broadly what we do. All these services are off-site. They should be subcontracted. The private sector has broadly done that. There is virtually no private sector entity of any scale which would store their own boxes. Please, government, can you give us a whirl? We are the preeminent operator. We're owned in the UK. We understand everything. We know what all the HMLR stands for and all the rest of it. We know all the acronyms. We know what we're doing, and you can sleep well knowing that we're looking after it. And if something goes wrong, nobody's going to blame you for using us.
So if anyone on the call has a direct dial to Rachel Reeves, can you get in touch?
Or they're working in a government department where they've got five Victorian houses full of cardboard boxes.
Love it.
And there are a few of those around.
I can believe it. Couple of questions on technology. One, do you consider it more of a standalone business when records, data shred, and digital all work so closely? And two, who are the main types of customers? Why are they increasing their spend? And who do you compete with?
Okay, it's a very, what we're about is people sleeping well at night. It's about security. So just as you want to look after, you want to shred your documents, you also want to make sure that all your IT is dealt with in an appropriate way. And it's interesting that somebody like the DWP, who's a big customer of our IT recycling business, we store their boxes. We also what else so we recycle our IT, we store their boxes, and we now run their mailroom. So very similar customer base, same principles. Get us to sort this stuff out. You don't know how to recycle your IT, etc. So it fits very firmly within the concept of what the group is trying to do. This is an extraordinary business, extraordinary sector. When I first started working in 1982, computers had just started arriving in offices, and still there is no structured industry around how you recycle these things. So it's clearly coming along in a big way. So our two business streams, we've got out of, we bought a business in my absence, which was basically something out of storage wars where we would turn up, collect a whole load of equipment for free, and then it would turn up back at our base, and we'd open the doors and go, what have we got here? That is a useless market. The people don't care about whether it's being wiped. They don't care about the ESG. Takes the same amount of time processing this stuff. At the end of it, you've got something worth a fiver rather than worth 50 quid. So we're very clear that we have two sectors here. One is blue chip customers. And the blue chip customers, when I first bought a business in this space in 2013, the 7 blue chip customers who were there then are still our customers, despite all the many ructions that have gone through in that business. These people, they want a reliable relationship. They want certification of, has everything been wiped? They want certification of where it's gone. So that is our core customer base. They include big IT giants, they include national organizations, they include accountants, banks, universities. We want to deal with those people. And those people are more concerned about paying us at every step of the road than they are about exactly how much they're going to get back from the kit at the end of it. So that is one of our markets. It's predictable. These customers will have refresh programs, which might happen every 4 years. They'll also do minor refreshes every year. We can sit down and talk to them about what their plans are, when it's going to happen. So that is really good quality work. And we're only in terms of end of life, please do not get your daughter to send us a phone. We're not interested. What we want is a big accountancy firm to send us 20,000 old laptops every 4 years and send us another 3,000. So that is one part of the business, which we're now doing out of our sites in Cannock, Runcorn and Birmingham. And also related to that, we have a specialist destruction unit, which can destroy anything, and that also you get great certification out of that. Possibly the more exciting, a more interesting space in terms of growth is what's called the channel. So this is where the value-added resellers, so that's Softcat, Computer Center, CDW, Beckler, they want to sell big lumps of tin. sorry, that sounds very rude. They want to sell a lot of computer units in one go to very big customers. But also what they want is they want those assets to be tracked. So they want to know that who has got what computer when it's arrived from from the OEM, from the original equipment manufacturer, or from the value-added reseller. And that is not what the value-added resellers want to do, but that's what their customer wants. So they come to us and say, here is my customer, such as the DWP. We will get them to check out all of your facilities, and then will you look after this product throughout its life cycle, so that when Hannah spills coffee all over her laptop, that she can ring up, say, my laptop's not working. We can get it collected, we can track it, we can send her another one, we can work out with her laptop whether it's had it, whether it needs to be broken up, whether it should be reconfigured, and reconfigured, sorted out, sent back to the next person who's starting. When somebody leaves the business, right, we know that they've got that computer, let's get it back, let's wipe it, let's get it ready for the next person. So this is a business which is growing, and which although you're doing broadly the same sort of thing as you are for the direct channel, that's the people you're just doing end of life for, it's similar because most of the activity is actually end of life, but you have to approach the customer in a very different way because they want very specific SLAs, service level agreements, etc. And so that's why we now have a dedicated site at Cardington which just does life cycle. So that's where we're going. In terms of the competition, as I say, it is bizarre that the structure in this industry, there are still rag and bone men picking up laptops from very established organizations, and it's bizarre that this hasn't sorted itself out. We think that's coming, and we are by far the largest operator in that space, and we see this as a real opportunity. In terms of competition, it's odd. There's a metal recycling business which does a bit of it. There are quite a few companies which are about a fifth of our size, independents. Computer Center is a VAR which we don't deal with because they bought back a business called RDC which does their own work. It's not really up their street. That's not really what they do. This is what we do. We do the service. We have the vans. We do all the processes, which we're very familiar with across our group. So we view this as a great opportunity. The competition is not there. It's interesting that globally, they haven't started in the UK, but Iron Mountain have followed my lead of 10 years ago and realized this is a logical add-on. So they will develop a presence in this. And we have seen some small private equity firms looking at this market and going, blimey. So we have to get our act together, which we're doing, and then we should be in a very strong position. And we feel that the demand from the channel is, once they have a proved supplier, there is plenty of work from them.
Well, and just a reminder, people, we do actually cover off Iron Mountain in James's research note in some detail, and some of the similarities. How many of the staff are contracted, short-term, and easy to reposition, remove?
It's pretty much exclusively in the Harry Green business. So where you have there is when you have spikes, you have big jobs. So, for example, the major pharmaceutical company which we did work for, we set up an office in Cambridge to recruit people, and I think at peak we had about 130 people supporting our skill set. We have seasonal in our exam contract, where we do most of the GCSEs and most of the A-levels, scanning all of those papers. That again is something which you have a spike, you bring in contract labour for that. And it's an interesting one actually, because within about a day we can work out whether somebody has got the manual dexterity to unpick all these papers. So there is a sort of bit of a selection process there. But generally across the group, we know all of our volumes in data shred. We know all of our volumes. We're getting better at knowing our volumes in technology, and sorry, that's IT recycling. We know our revenues. So records management, data shred, and IT recycling. We have very little contract labour, unless occasionally in IT recycling, if you get a whole load of stuff in, you might haul a few people who've worked for you in their holidays back in. but that's about it. So we have significant flex in Harrow Green in terms of labour. It's also quite interesting when you get very busy in Harrow Green, your margins actually drop because contracted, bringing people in, they are less efficient and effective than our existing people. So yes, you've got to do the job, but actually it takes longer because they will be people who typically work part-time for us, but they won't be as skilled as our general operatives.
Okay, I'm conscious of time. We do have two more questions, perhaps. One's hopefully very quick. Are annual box risers prices in the contract?
Yes, there has been a shift. It was odd because, as I noted, prices didn't move for 30 years. When we got significant inflation, the previous management was very slow in pushing those price rises through. So we kind of missed the first year of those inflation-related things, which it's actually the best time to do it is immediately because everybody's used to sort of going, "Blimey, prices are going up." No wonder their prices have gone up. We've caught up with that inflation spike by having our 7% increase in January. But as part of that, there was a lengthy process which now links the majority of our records management contracts to CPI and RPI. So our job in driving up margins in that business is to accept that we will get inflation-related price rises, and our job is primarily through moving to cheaper sites is to try and we will keep our costs at below inflation increases, and that's where you get the operating margin increase from.
Okay, and final one is on the DWP contract. Just in terms of the process and whether a relationship with a new Labour government should be seen as a positive driver for future growth.
I think that with a focus on, every government talks about government waste. I think that this government has really thought about it a bit harder than doing it on the hoof. So we think that is helpful for us. It was interesting that there were 3 public sector tenders, including the DWP. DWP has been out there for 6 months, and that within 2 or 3 weeks of the election result, actually the wheel started to turn and people went, okay, fine, we're allowed to do that. So I think some of our activity might have been a bit subdued generally, partly because do you want to award a significant contract before a change of government? You want to actually make sure that nobody's going to go, who is the idiot who did that? So we've seen things free up there a lot. We think there are other government contracts which we've tendered for, which should come through more quickly now.
Brilliant. Well, thank you all for joining us this morning. Thank you to both of you for a really helpful explanation there. We'll look forward to more in 6 months' time.
Great. Thanks very much, Hannah.
Thank you.